Okay guys, hi again. This is the fifth video and last video in the series. Now let me forewarn you that this is quite a complex subject, and I was hesitating on whether to put it on this video series, but I've decided to do so because there's a lot of volatility in the markets now in 2016 January, the first month, and you need to really understand volatility to understand what's in the market. And just as we went through the previous video, when things are volatile, I really don't know where it's going, and I'm rarely in the market these days, despite getting a pretty good return for January 2016. So really, guys, you don't have to be in the market to make returns. Just don't get into trouble. Don't mess with things like volatility if you truly, truly don't understand it. So let's get started. Okay, what are signs of volatility? Well, this is when markets are really going wild and are falling fast. And then you see the rise in this something called the volatility index. It's VIX. Okay, you can find it on Yahoo Finance. This happens, see, because markets are falling down. Investors, in order to protect their long position, stock position, they buy a lot of put options. Okay, so as the put options are being purchased, the volatility index then goes up, and this is really a gauge of fear, okay, because people are fearing that the markets will go down, and that's when the put options go up. So the value of VIX really under normal situations is really below 20, but when it starts getting above 30, that's when you see a lot of volatility. Now you see the peak in the VIX normally at 40 to 50. This is when a panic set in, and there's a peak panic point, and this is when the VIX starts to go to 40 or 50. And then once it goes down, this is when the market turns around, when you see a downturn then turn into a temporary bottom and the market starts going back up again. This represents the normalization that Soros was referring to in our previous video. Does it peak at 40 or 50? Normally, but it can go much higher. For example, in the 2008 credit crisis, the VIX actually went up to around 90, and it was at above 40 for quite some time. So just imagine the turmoil of the markets then. Now, this just shows you the level of the VIX during some panics. You see there, 2011, that was Grexit. VIX was clearly around 45 to 46. Recently, you can see in August last year, the China Black Monday, VIX was around more than 50. And look, that was the peak, and then it went down, and then the market started to rally again. For those of you that still remember that. Now look at this. We're looking now more backward in time to look at the crisis. The VIX went around to 50. And look at the crisis then. That was the Asian contagion and also long-term capital management, the Russian crisis. Enron, WorldCom, and Iraq also brought the VIX up to 50. But it was the subprime that was the king of the VIX, because that brought it up to 90 when Lehman Brothers simply imploded. So again, a high VIX represents this fear in the market, and usually results in huge market corrections, or even a crash. Okay, what we see now is also a lot of correlations, weird stuff. We see a lot of correlations between markets and oil in January 2016. This rarely happened, but what we see now is basically when the oil goes up, the market goes up. Oil goes down, the market goes down. Now, it is not always this way. The correlations usually do not last, as you can see on the chart on the right. But when the correlations do last, then are here now, for example, you want to take the trade based on that. Just base your trades on the correlations. For example, when oil goes up, the market goes up. By right, the commodity currency should go up, right? So the Canadian dollar should go up. So you can play, this is a good way to play the Canadian dollar using oil and also the S&P 500 as the proxy for your entry and also your exits. Okay. Now, another interesting thing that's happening here in January 2016 is this correlation between, hey, guess what? VIX and the price of oil. It seems that the market turns around when VIX goes higher than the price of oil. This is easy now because the price of oil is low, and we actually saw that, in actually August 2015. That's kind of weird. But again, once the correlations are here, just play it. Just remember, it doesn't last. So guys, I'm going to go now. I hope you enjoyed this 5-video series. Just tune in for more emails and for more ebooks and also training resources that I'm going to put in at my website. Thank you, and bye.